Hey everyone, welcome back to Freedom Jump today. We're diving into a topic that could be a game changer for your financial future, diversification of assets. If you've ever wondered how to protect your money, grow your wealth, and sleep better at night, this video is for you. Diversification is like the Swiss Army knife of investing. It's simple, powerful, and honestly, kind of underrated. Stick around for the next 10 minutes, and I'll break down what it is, why it matters, and how you can start doing it today. Oh, and if you find this helpful, hit that like button and subscribe. It really helps the channel grow. Let's begin. So, what exactly is diversification? In simple terms, it's the idea of spreading your money across different types of investments or assets, so you're not putting all your eggs in one basket. Imagine you're at a buffet. You wouldn't just pile your plate with only mashed potatoes, right? You'd grab some salad, some chicken, maybe a little dessert, because variety keeps things interesting and balanced. Diversification works the same way with your money. The goal here is to reduce risk. If one investment tanks, the others might still hold strong and keep your portfolio afloat. Think of it as your financial safety net. The main asset classes people diversify into include stocks, bonds, real estate, cash, and even things like gold or crypto. Each of these behaves differently depending on what's happening in the world. And that's the magic of diversification. It's all about balance. Okay, let's talk about the big R word, risk. Investing is awesome because it can grow your money over time, but it's not a straight line up. Markets go up, markets go down, sometimes way down. Remember 2008? The stock market crashed, and people who had all their money in one stock or one sector, like housing, got hit hard. But those who were diversified, they weathered the storm a lot better. Here's a quick example. Let's say you invest all your money in a single tech company. If that company has a bad quarter, maybe a product flops or a scandal hits, your savings could take a nosedive. But if you'd spread that money across tech stocks, some bonds, and maybe a real estate fund, the damage wouldn't be as bad. Some parts might even go up while others dip. That's the power of not betting everything on one horse. Plus, diversification isn't just about avoiding disaster. It's also about capturing opportunities. When one asset class is slow, another might be booming. You're giving yourself more chances to win. Now, let's get practical. How do you actually diversify? Don't worry. You don't need to be a Wall Street pro to do this. Here's a simple 4-step plan. Step 1. Know your goals and risk tolerance. Are you saving for retirement in 30 years? Or a house in 5? Younger folks might lean heavier into stocks for growth, while someone closer to retirement might prefer bonds or cash for stability. Figure out what you're comfortable with. Step 2. Mix up your asset classes. Start with the basics, stocks for growth, bonds for steady income, and cash for emergencies. Then, sprinkle in some extras, maybe real estate through a REIT, or a little gold if you're feeling fancy. Step 3. Diversify within each class. Don't just buy one stock. Spread it across industries like tech, healthcare, and energy. For bonds, mix short-term and long-term. Variety is your friend. Step 4. Use funds for simplicity. If this sounds overwhelming, try index funds or ETFs. These are like pre-made diversification baskets. One fund can hold hundreds of stocks or bonds, giving you instant variety with a single purchase. The key: start small and build as you go. You don't need millions to diversify, just a plan and some consistency. Before you jump in, let's talk about a few traps to avoid. Don't overdo it. Diversifying into 50 different things can get messy and expensive. Aim for balance, not chaos. Studies suggest 20 to 30 investments can get you most of the benefits without overcomplicating things. Second, don't confuse diversification with guaranteed wins. It reduces risk, but it doesn't eliminate it. You can still lose money, especially in a big market crash where everything drops. And finally, don't set it and forget it. Life changes, markets change. Check in on your portfolio every 6 months or so to make sure it still fits your goals. Rebalancing is key. Let's tie this together with a quick story. Meet Jane. She's 30, saving for retirement. She puts 60% of her money in a stock index fund, 30% in bonds, and 10% in a real estate fund. One year, stocks dip 10%, but her bonds go up 5%, and real estate holds steady. She doesn't panic. Her portfolio only drops a little, and she keeps investing. Over time, that balance helps her grow her wealth without the rollercoaster stress. That's diversification in action. So what's the takeaway? Diversification isn't sexy, but it's smart. It's about playing defense and offense at the same time, protecting what you have while giving it room to grow. Whether you're just starting out or leveling up your investing game, this is a strategy worth mastering. That's it for today, folks. If you enjoyed this deep dive into diversification, give it a thumbs up and let me know in the comments, what's one asset class you're excited to try? Don't forget to subscribe and hit the bell so you never miss a video. Thanks for watching, and I'll see you in the next one.